Wall Street wants a piece of your 401k, not your salary, not your brokerage account, the retirement money you never look at. About 70 million working Americans hold roughly $10 trillion in 401k plans, and for 4 decades the most aggressive investment firms in the world were locked out of that money. This year, the door is opening. Private equity, the business of buying whole companies with borrowed money, is being cleared to sit inside the default fund your paycheck feeds every 2 weeks. The pitch is that you are finally being let in. The question worth asking is smaller and sharper. Why now? Why would the smartest money on earth suddenly need yours? Here's the uncomfortable answer. This exact story has already happened. December 1928. The most respected investment house on Wall Street decides the public is ready for a new product. Waddell Ketchings is the senior partner at Goldman Sachs, a Harvard-trained banker, a best-selling economics author, and by most accounts, the most optimistic man in American finance. His creation is called the Goldman Sachs Trading Corporation. It is an investment trust, the hottest financial product of the 20s. You hand the trust your money. Professionals invest it for you. Diversification, expertise, access. The small saver finally gets what the big institutions have. The sales pitch in 1928 was democratization. Hold on to that word. The trust issues 1 million shares. Goldman takes them at $100 each and sells them on to the public at $104. The public wants in, everything is going up, and the name on the door is Goldman Sachs. 2 months later, the stock hits $222.50, roughly double the value of everything the trust actually owns. What was driving it? Here is the first mechanism worth remembering. The trading corporation was buying its own stock. By March of 1929, it had spent $57 million, more than $1 billion in today's money, purchasing its own shares, booming its own price. Then it quietly resold a block to a market operator named William Crapo Durant, who fed it back to the public as opportunity allowed, a fund whose best-performing holding was itself. In February 1929, this looked like genius. Then Ketchings did it again. In July 1929, the trading corporation launched a second trust, the Shenandoah Corporation, and sold a slice of it to the public. 25 days later, Shenandoah launched a third, the Blue Ridge Corporation, and did the same. Picture nesting dolls. Blue Ridge sits inside Shenandoah. Shenandoah sits inside the trading corporation. Each layer borrows against the layer below through fixed dividend preference shares, so every dollar of gain at the bottom multiplies on its way up the chain. Nobody dwelt on what the multiplication would do to a loss. 10 weeks later, the market crashed. You may have heard how this ends. The famous version, it is in Galbraith's classic account of 1929, says trading corporation stock fell from $104 to $1.75, a 98% loss. The record is slightly kinder and somehow worse. Adjust for a stock split along the way, and the honest number is about $3.50 against that $104 offering price. 97 cents lost on every dollar, not a legend rounded up for effect, a real, audited number. The saver, who bought what Goldman was selling in 1928, lost essentially everything. Ketchings was pushed out by 1930, and the firm spent a generation living it down. So far, a good crash story. Here is why it is not just a crash story. Go back to the question the opening asked. Why now? Why 1928? And why 2026? Both times, the answer is the same uncomfortable sentence. The professionals were running out of professionals to sell to. Investment trusts were how Wall Street manufactured new buyers once the sophisticated money was full. The numbers tell it plainly. Americans held under $200 million of investment trust shares in 1927, nearly $800 million a year later. By 1929, new trust issues alone topped $2 billion, better than a fifth of all the stock being sold in America, and the number of trusts had roughly doubled in 8 months. The product was not invented for the little man. It was aimed at him at precisely the moment the big money stopped buying. Now run the modern side. Private equity spent 15 years as the darling of pensions and endowments. Then rates rose, the exits froze, and the institution stopped writing new checks. By this year, the industry sat on something like $4 trillion of companies it bought and cannot profitably sell, tens of thousands of businesses waiting for a buyer who has not appeared. Fundraising stalled, and in August of 2025 came an executive order clearing the way, followed this March by a Labor Department rule proposing to welcome private assets into 401k default funds. The order's own title used the word democratizing, the same word, 97 years apart. Understand what is being purchased here, because it is not what is being sold. Private equity is not offering to cut the public in on its returns. It is asking to borrow the public's patience. A 401k contribution is the most patient money in America. It arrives automatically every payroll. It never panics, never redeems, never demands a daily price, and does not plan to leave for 30 years. For an industry holding assets it cannot sell, at valuations it largely sets itself, that patience is not a customer base. It is an exit. The trusts of 1929 would not tell shareholders what they owned. Private funds price their own holdings on their own schedule, marked far less often than a stock and graded, in the first instance, by the people who bought them. And the fee schedules riding along are the kind the index fund era was supposed to have buried. Different century, same direction of travel. Complexity flows toward whoever asks the fewest questions. Now, where the rhyme breaks, because it does, in ways that matter. The saver of 1929 had no protection at all. No disclosure rules, no fiduciary standard, no regulator reading the prospectus. The law that governs funds today, the Investment Company Act of 1940, exists specifically because Congress spent years studying what these trusts did. The 2026 version arrives inside a fortress the 1929 version built. Employers who add private assets to a 401k are fiduciaries, and fiduciaries get sued. The exposure comes capped inside target date funds, a slice of a diversified portfolio, not the whole account. And the underlying assets are operating companies with revenues, not pyramids of paper claims on other pyramids. A repeat of 97 cents on the dollar is not the live risk here. Anyone who tells you it is selling a different kind of exaggeration. So where does the rhyme go next? 3 things are worth watching, and none of them require a prediction. First, the final Labor Department rule, expected around the end of this year. The detail that matters is disclosure, whether plans must show private asset fees and valuations next to the index funds they sit beside in numbers a saver can compare. Second, the first real downturn. Private valuations move slowly by design. Watch whether funds inside retirement products limit withdrawals when public markets fall and private marks have not caught up. That gap is where the patience being borrowed actually gets spent. Third, the sales language. In 1928, the tell was not the product. It was the urgency, aimed at the people who ask the fewest questions. When democratization shows up in an advertisement, ask who needed whom first. Money in history does not give investment advice, and nothing here is a reason to buy or sell anything. Wall Street wants a piece of your 401k. It wanted the same thing in 1928. You now know what it needed it for, and you know what the people who said yes were actually providing. The knock on the door is not the danger, the hurry behind it is. Watch the rule, watch the fees, and this time, make the salesman answer the question nobody asked in 1928. Why us?